Dear students, welcome you all to session 12 video of the chapter Financial Statement Analysis, 5th semester BCom, Mangalore University. In the previous session, we have seen the meaning of financial statements. We know that financial information is required for financial planning, analysis and decision making. This financial information is provided by the financial statements, which are actually the basic annual reports prepared by the management to communicate the financial information to the owners and various other users of the financial information. So the main financial statements are profit and loss account and the balance sheet. Now, financial statement analysis is the process of critical evaluation of the financial information contained in the financial statements. Now, why this critical evaluation is done? It is done in order to understand and make decisions regarding the operations of the firm. Now, it's actually a process of identifying the financial strength and weaknesses of a firm by properly establishing relationship between the items of balance sheet as well as profit and loss account. It's actually an examination of the financial statement for the purpose of determining the strength of a business firm, the leverage, capital structure and trends of various components of financial statement. So it's actually a study of relationship among the various financial facts and figures as given in a set of financial statements and the interpretation made in order to gain an insight into the profitability and operational efficiency of the firm to assess the financial health as well as the future prospects of the business organization. So it is actually done in order to determine the profitability or the earning capacity of the business, and it actually helps in assessing the financial health of a business as well as the future prospects as well as progress of a business concern. Now, this analysis of financial statement, it actually provides classified and easily understandable data to understand various aspects of the business enterprise, and it is very important for the shareholders, the owners of the business firm. It helps them understand the present as well as the future profitability of the business concern. It also helps them understand the financial position as well as the risk undertaken by them. At the same time, the financial statement analysis is also useful to the prospective investors, that is those who would like to invest in the business firm. They would like to know the earning capacity as well as the financial health of the enterprise before investing their funds. So they would like to know the rate of return of the investment, whether the money they invest will be safe or whether they will be company will be able to repay the debts, and what are the future prospects of the business concern. And at the same time, the financial analysis is important for the management also to ascertain the profitability of the business enterprise, to ascertain the trend of progress of the concern, to know the future forecast of the production or sales or expenses, purchases, etc., to know the financial position, to know the efficiency of the business or operations, to identify the factors responsible for operating or managerial problems in the organization. And the financial analysis is also helpful to the debenture holders. They would like to know about the capital structure of the company, whether it is satisfactory, whether the company has adequate assets to offer as security for the debts and the risk undertaken by the firm, whether the firm has the liquidity position is good or not, whether the firm earns sufficient profits to pay the interest on debentures, etc. In the same way, financial statement analysis is useful for the banks and other financial institutions because they would like to know about the liquidity position, that is the short-term solvency position as well as the long-term solvency position of the firm, whether they will be able to pay back the loans or advances, whether the company has the sufficient assets to offer as security, or whether the amount used by them is properly utilized by the concern. Now, the trade creditors or the suppliers of goods would also would like to know about the company's financial information, that is whether the production as well as sales are increasing or decreasing, whether the company has liquidity, whether the profitability of the company is good, that is whether the concern is earning enough so that the debts can be cleared off and all. In the same way, the employees of the business concern are also interested in the financial statement analysis because they would like to know the profitability of the concern, which will actually help them to decide whether they can demand increase in their wages or bonus or other facilities and all. They would like to know the financial position of the concern, the long term as well as short term financial position, to know whether their employment will be permanent and other matters like that. Similarly, financial statement analysis is useful for the government because it helps them have a correct assessment of the taxes as well as to regulate the prices of the goods produced by the enterprise. So in this way, financial statement analysis is actually a critical evaluation of the financial information in order to understand the financial strength and weaknesses of the business concern. So for this purpose, the the information contained in the financial statements are used in order to understand the financial strength and weaknesses. It actually helps the shareholders, the owners of the business firm, the management, the employees, the general public, the government, the prospective investors, the creditors, banks and financial statements. Now, there are different tools of financial statement analysis. The first one is the comparative statements. So comparative financial statements. So we have the comparative profit and loss account and comparative balance sheet. Similarly, we have common size statements where we have comparative income statement, common size income statement and common size balance sheet. Then we have the trend analysis, and the fourth one is ratio analysis, and the fifth one is cash flow analysis. So these are the important tools of financial statement analysis. So first one is comparative statements, second one is common size statements, and third one trend analysis. The fourth one ratio analysis, which you will be studying under your subject financial accounting, and the fifth one is cash flow analysis, which again you will be studying in the subject cost and management accounting. So the first three methods, that is comparative statements, common size statements and trend analysis, will be dealt in the following sessions. Thank you.